Good evening, everybody. Welcome to the channel member exclusive video for November. Oh boy, we're moving along pretty quickly. We're moving along pretty quickly for sure. So, uh-oh. This is what happens if I don't mute. There we go. If I don't mute a tab, we get that feedback, and it gets a little bit wonky. But we got that taken care of really, really fast. Tonight, we're going to be talking about options. So we're going to talk about options. That's our main theme. But as always, you guys are the channel members. You can ask anything you want. We'll go on whatever tangents you guys want to go on. We'll look at stocks. We'll do whatever you guys want. In addition to, of course, options, all that fun stuff. All right, let's start here with, and here, give me 1 second. Let's get myself over to the whiteboard. Oh, we got the goat up there. What's going on with that goat? There, let's get rid of the goat. All right. All right. So options. All right. Fun stuff. Let's see. JJ is in the house with a hey-yo. Hey, JJ, good to see you. And I'm going to dominate this conversation. All right. It sounds like a challenge. All right. So I know that when you guys selected options as our topic, that you were hoping for a Wealthsimple walkthrough. You're not going to get that. We're going to cover everything about options. We're just going to talk about the different types of options, how they work. We're not going to look at the interface of any one particular broker. Not this time around. I actually do want to do a walkthrough as a regular video one of these days. I did not have time today. Today, let me tell you, a very busy day. I had my meeting with Evolve, and I also went and got a flu shot and a COVID shot. So one of my arms is a little sore. So a fun day. All right. So what exactly is an option? That sounds like a really good place to start. Whoa, I just dropped it down there. Very basic. An option is basically just a financial contract. There we go. Contract. Perfect. All right. Don't worry. I'm not going to write out every single thing I can't say. Otherwise, we'll be here till midnight. But in a nutshell, options are financial contracts. So very, very easy. And we're going to look at that. We're going to look at how these contracts work. We're going to look at everything from longs, shorts, what's a put, what's a call. We're gonna cover all of that tonight, so don't worry. All right, Kiev Kaz is in the house. Can't stay long, but intrigued about the topic. Afternoon, gang. Yeah, absolutely. So here's the beautiful thing. If you can't catch this tonight live, the replay will be there for you. And plus, the best thing about the replay is, you can pause it as you're going. Like if you're like, oh, I want to write something down, you can do that. Absolutely. So that's kind of an interesting thing here. But I will say right now, so basically, all right, goodbye. All right, I did actually write some stuff up in a document because here's why. I did this because let's see here, Command C, Command V. All right, let me grab this here. Give me 1 second here. I figured it'd be a lot faster to do copy and pasting than to just, type it out as we're on the fly. All right, let's come in here. All right, we'll see how this works. Boom. It does not work at all. Here we go. All right. So basically, and I'm just going to bring this. You know what? I need to have this that way. No, it's still not doing it right. All right. All right. Ah, boy. All right. Let's just do this. That brings us mostly there. Okay. All right. We're not going to do this. That's not going to work. But in a nutshell, it gives the holder the right, but of course, not the obligation. So if you buy a contract, that you don't have to take it. And we're going to talk a little bit about that as we go along. Basically, you're buying it at a predetermined price before a specific date. So, and that's something called a strike price. We'll talk a little bit more about that as we go. Yeah, dear. You know what? I wonder. Just give me 1 second here. I wonder, now that I changed it to... Now, it's still doing it. It's still doing it. All right. Oh, well, that's fine. I'll just put down key points if I think it's something that you guys need. I think for the most part, a lot of you guys have been around the community, been around investing enough that you probably have a kind of an inkling of what a contract is. So basically, yeah, they're a contract. You're basically saying, I'm going to buy. Actually, you know what? Let's boil this down to really, you know what? I'm just going to do it this way. Yeah, that works better. Yeah. Give me 1 second here. There we go. For the nutshell, you're going to buy X stocks. So X number of stocks, at X price on X date. There we go. Now I will point out that when you are dealing with options, they come in units. So you have to buy. Basically 100. So that's what it is. So if you want to go and buy some options on, let's say a stock that's $20. Well, you got to buy 100 of them. So, you're looking at what, $2,000? So you have to, it is costly. It's not easy money for sure. But you do have to buy a minimum of $100. They come in units of $100 when you're doing options. So it's kind of interesting. It's kind of interesting the way these work. Now, they are actually considered, if you've ever heard that word derivative, they are considered to be a type of derivative, and that basically means that their value is derived from the underlying asset. So hence the word derivative. That's basically why they call it that. All right. Oh, JJ's in here. JJ says, I greatly enjoy options. I'll probably end up trading my own eventually when I do decide to retire early. No, nothing wrong with retiring early, that's for sure. Yeah, so there's two basic types of options. And we'll just put it I wish this would just pop in right underneath. But yeah, so you've got two types. You've got call options. And I'll just put it up here as well. You've also got put. So put options. All right, I'll drag this over. Not the best whiteboard, but I still like it. I like the fact that I can move my letters around. The last whiteboard I used to use, I couldn't really move things around very much. But yeah, so you got call options and you have put options. So a call option basically gives the buyer a right to buy an asset at a certain price. So this is kind of ideal for investors who are expecting a price increase. So if you're thinking the price is going to go up, you're probably going to exercise a call option on it. Now a put option, this gives the buyer the right to sell an asset at a certain price. So this is useful if you think the price is going to go down. So pretty simple. So call, you're expecting the price to go up and you're going to buy an asset. Put, you're expecting the price to go down and you're going to sell an asset. So there we go. We got those two out of the way. Now there's three things that you have to understand. First of all, when we come back up to here, if you look at on X date right here, I'm going to put this right over here. Well, X date is basically this is going to be your well, first of all, let's not look at the X date. X date is basically your expiration, so we'll put this in X. So that's when it expires. Your X price is going to be, actually I can leave price there, it's your strike price. So these are just a couple of terms. So when you do an option, you are going to, first of all, you're going to, let's say, I'm trying to think of how to word this the right way. Oh, we'll push, we can push these up a little bit. So let's say, for example, you're running an option, and what you're looking to do here is, I'm going to, where is, oh, I can go sideways too. Oh, nice. All right. I need to get over here to draw. All right. I'm just going to use the draw for a bit here. So if you were, let's say, we'll use the numbers. So you have to buy 100. We're going to say Banana Co. We'll just say BC for Banana Co. All right, and it's priced at, conveniently, it's priced at $10. All right, so what you can do option-wise is, let's say, for example, you're holding this Banana Co. and you think that price is going to, let's say you think it's gonna, you think it's gonna go down. You think it's gonna go down. So you think it's gonna go down to, let's say you're expecting it to go down to like $9.90 over the next week or so. I'm just picking numbers off the top of my head, guys. So what you can do is you could sell an option, and then you sell it at what's called a premium. So a premium is how much somebody has to buy that option. So they have to pay this premium. So let's just say we put a premium on here. And we'll say to buy those 100 shares, it's going to cost them, let's just say it's going to cost them, let's say $10. Actually, more realistically, we'll say 50. So they're paying $50 to buy this contract. So what you're basically saying in this contract is you have to put out the terms. So you're thinking the price is going to go down. The person who's buying the contract thinks you're wrong. They're thinking that the price is going to go up. So what you're going to do is you're going to say that if, so in the contract, you'll say that if by, let's say, we'll say December 1st. So if by December 1st, it goes up to, and we'll give it a strike price. We're keeping it simple, right? We're just going to say 10.10. What that means is they paid you that $50. If this goes up, so let's say the stock does go up. Let's say they're right, and it's a situation where it goes up to, let's say it goes up to 10.20. Well, in that situation, you agreed to sell it at 10.10. And if on December 1st it's at 10.20, or they can exercise it before December 1st. Once it's passed, or sorry, they cannot do that. They can't exercise it before. Never mind. I don't know what I was thinking. But once they hit that expiration date, they have that right to buy it. And even though it's at 10.20, they're going to buy it at 10.10 because that there is the contract. So what has happened for them is they have spent $50. So they've lost $50, but we're looking here at, 10 times 100, so 10 cents times 100, that's $100. So they've lost 50, but they gained 100. So they gained that 100. They lost that 50. So basically, they're in $50. So they're in $50. All right. Now you had to sell. So you had to sell at 10.20 in this case, or sorry, at 10.10. So you do still keep that $50. That $50 that stays with you. No matter what happens. No matter what happens, you keep that $50. It's pretty cool. It's pretty cool. But you've had to sell. You had to sell your 100 shares at 10.10 when they're worth 10.20. So not good. It's not good. But that's a worst case scenario. In this case, you technically lost money. I mean, obviously what you're probably going to do is you may not buy back those shares. You may wait it out. You may wait it out and hope that it retraces. But now, if it's, let's say, for example, instead of the 10.10, let's just say it did go to 10.10. So if it went to 10.10, that person, so this person, they could exercise. They could take that. They could make you sell it to them for 10.10, but they're probably not gonna. Why are they going to do that? Because the reason that they're not gonna do it here is, they've already spent that $50, and it's, they're not gonna make. They're just, they're not gonna really make anything here. So in this case, in that situation, so 10.10, they're probably not going to exercise it. They might. Some will. You're not going to make a lot of money here. But here's your ideal situation. Your ideal situation is if it went up to 10.09. So if it went to 10.09, then the contract expires worthless on December 1st, and you get to keep your shares. So you get to keep your shares. Doesn't matter what happens after that. Plus, you get to keep the $50. So that's one of the things that makes contracts very, very attractive. Is just because you do get to keep all of that extra money, and that's not too shabby. It's not too shabby at all. JJ says, so in other words, sell a call is a bearish play, sell a put is a bullish play, and buys are the exact opposite. Yeah, pretty basic. It's basically that. We're going to talk a little bit about, you also will use example is the word shorting and longing. And we're going to talk a little bit about that here in just a moment. All right. So once again, just to clarify those three terms, the strike price, that is that price at which that option can be exercised. Pretty darn simple. All right. Expiration date, that's a date by which the option must be exercised or it becomes completely worthless. Options can have different expiration cycles, such as you can have one, like you can have a week. You can write one for a week, one for a month. You can even write options for a whole quarter. So that's another kind of consideration when you're writing an option, is you want to sort of be looking at which time frame do you think is going to work the best for you. But here's that thing. If you hit the strike price before the expiration, and this is kind of where I think I was going at before, they can buy it at that point. They don't have to. They might let it go higher and then come in and say, okay, we're picking it up now. But that's kind of one of those things. And you notice how when I talk about covered call ETFs, how they can lose that upside potential. It's basically for that reason, right? So if this covered call ETF, in this case here, let's just pull this down here. In this case here, if they have a strike price of, let's just say, let's say they go with 10.20, and Banana Co explodes, and all of a sudden it's up here. It heads up to, like, say 10.30. Well, what's going to happen is, at 10.20, that might get they might actually go after that. So the buyer of their contracts may take it, and all of a sudden it's 10.30, and they no longer have the stock because the stock has already been bought. So they have to buy back in. So when they buy back in, you've basically missed that little area there. So it's only 10 cents, but it does start to add up. Hi, kitten. What are you doing? You don't need any treats. The kitten is over here bugging me for treats. Yeah, so that's kind of why you lose. And the more fast a security is going up, the more this can happen. And that's one of those big things. So, and we've looked at that. We'll even look. We'll look a little bit. Yeah, actually, you know what? Let's actually look right now. Let's just head over here. The example I love to use the most is BTCY. So this is that purpose Bitcoin. Now, one of the reasons I like to use this one is because we have this perfect example here. So basically it was launched right around here, and then Bitcoin went into a crypto winter. So that was the big 2001 fall, and you can see this went down. Now, think about where Bitcoin is right now. Bitcoin back here was in the, was just, in the 60,000 area. So that was its all-time high, a little over 60,000. And what is it right now? Well, it's like, around 90,000 right now. And you'll notice that it was still higher here. So even as Bitcoin caught back up and passed all the all-time highs, this security never caught back up to where it was before. And that's because every time Bitcoin had a major big pump, that strike price was being hit. And people, whoever was buying the contracts was exercising it, basically taking the Bitcoin in this case from Purpose, and then Purpose had to buy back in. And most times the price was already up a bit more by the time they had to buy back in. So it's, and that just means that there's less market cap for this ETF. So this ETF keeps on coming down every time that happens. So it's, it's one of those situations. So when you're investing in something like this, if you're like a long-term investor, if you're in it for the returns, especially if you're in it for the growth, that's probably not the best way. In here, with this one here, you're pretty much going to be here for the, for the dividend. It is a nice dividend. And if you do reinvest that dividend, keep in mind, every time they pay the dividend also pulls down that share price as well. So there's two factors going on there. But if you are here if you reinvest the dividend, you get a lot closer. You do get a lot closer. You don't get all the way back, but you do get a lot closer. So, just something to think about. All right, let's see here. So obviously we got two people. Every contract has two people involved. You have the buyer and you have the seller, or the writer. Sometimes they call the seller the writer. So the buyers, those are the investors who purchase the option to basically speculate on the market, and sometimes they're doing it to hedge against some of their existing investments. The seller is the writer. These are investors selling options to earn income from the premium, because that's what it's all about for the sellers. You want that premium, and you're hoping that your option doesn't get exercised, because that's, like I said, that's your perfect scenario. And the sellers, they have an obligation to fulfill the contract if it is exercised by the buyer. And like I said, sometimes they don't. Sometimes they don't. If it's especially if they're looking for a bigger payday. Sometimes they just, they're like, it's not even worth it because we just hit the strike price. They're looking for it to exceed the strike price because that's their best case scenario. All right. Now that we kind of got a basic idea of, oh boy, look at all that red. Why would we want to use options? This is kind of that kind of a big question. So why do people use options? There's a few different reasons. One is, I guess we can go big screen for this here. Give me a second. Let's get back to big screen. Boom. Okay. Perfect. One reason to use options, of course, is they're used often for hedging. So what you're doing in that case is you're basically protecting your investments against adverse market movements by basically trying to create an insurance policy by using options. There we go. So a stockholder, in this case here, like a good example of this is a stockholder may purchase a put option to protect against potential losses if that stock price decides to drop. So that's kind of the whole idea of hedging. Now, at the same time, a lot of people are doing options because they're speculating. So they're basically taking a bet on where they think that movement of the asset is going to go. And if you're good at sort of sourcing out where something is going to go, you can make a lot of money on options. People right now who have been taking out big longs on Bitcoin, some of them have made small fortunes because Bitcoin has done pretty much what they were expecting it to do. So that's always a good thing to do. Now, buying a call option on a stock is, if you think it's going to rise, if you think it's going to rise sharply, it's not a bad idea. It's not a bad idea at all. Also, income generation. Obviously, some people are in the game because they want to make serious income. That's what a lot of the ETFs, covered call ETFs, are doing. That they're in the income generation game. So they're selling those options to create income so that they can pump up those dividends that they're paying out to you guys. So that's kind of a good way to go as well. It can be used to create cash flow. And best example, as I already mentioned, covered calls. So that's what they're doing right away. So they also get the dividends. So usually if it's a dividend stocks in their portfolio, they're getting the dividends, they're getting the premiums, and then they're also getting some of the growth as well. So that all completely adds into those higher yields that you get. I mean, that's what it takes to be able to pull off like a 14 or 15% dividend yield. You just need you need to have those. You just need all of that extra income. That's where it all boils down to. All right. Oh, good old options. Love them. All right. So there's a few different ways you can sort of approach things. So there's buying calls. So when, of course, you are optimistic and expect the price to go up, that's when you're going to be looking at buying calls. So there is a risk, of course, that the premium, let's just say the risk is kind of limited to the premium paid for the option. Now, if the stock does not rise above the strike price, that option expires worthless. So that's where the danger is. So when you're paying that premium and you don't get to the strike price, you've just lost that money. It's simple as that. It's just gone. There's no upside to that at all. So you want to if you're buying options, you want to really be, I would say confident. Like I would definitely say if you're new to options, you want to do your due diligence, and then you want to double check your due diligence after that before you get into it. Now, of course, the reward, there's no cap on that reward for you because, a stock can go to the moon. If you happen to, if you're buying an option and you're buying that contract and, you get a strike price, like in the case of Banana Co., let's say the strike price was 10.10. If this thing all of a sudden explodes and goes up to $20, you're buying a $20 stock for $10.10. So that, I mean, conceivably, it could go even higher. I mean, in severe cases, I mean, you're normally not going to have a stock double in a quarter, but you never. Well, with penny stocks, you probably could, but be really, really careful with penny stocks. They are a little bit on the dangerous side. So I definitely would sort of. Yeah, I would avoid those. Personally, I would. Let's see here. Now, when it comes to buying puts, so that once again is when you're expecting the asset to go down. Your main risk, it's limited to the premium paid for the option. So if the stock does not fall below the strike price, once again, that option becomes completely worthless. The reward for that, basically you got gains as the stock falls. So if the stock price drops significantly below the strike price, the put can become highly profitable. So that's not a bad thing. So this is, once again, you're betting on that stock going down. So that's pretty cool. So let's see here. All right. And this kind of takes us to longs and shorts. All right, give me a second here. There we go. So, of course, you probably have heard of longing a stock and shorting a stock as well. Oh, give me one second. Oh. I was trying to pull up something and I accidentally clicked on the wrong button and an email client just popped up in front of me. All right, so basically going long is, you're buying the option. So you're basically buying either a call or a put with the expectation of a price move in a specific direction. So with a long call, buying a call option because, you expect it to, you expect the price to increase in value. Now there's also a long put. So the first one's a call, the second one's a put. So with a long put, you are expecting, you're buying a put option because you expect the stock to decrease in value. So, and the same thing goes with shorts. Like with selling shorts, you have a short call. So you're selling a call option to collect a premium, betting that the price will stay below that strike price. And with the same thing, you can also have a short put, which is selling a put option to collect a premium, betting that the price will stay above the strike price, which is pretty good. When it comes to risk, though, with shorting, if you're doing a short call, you have a higher risk. So, because if the stock price rises above the strike price, you could technically face unlimited losses. So that's kind of a big thing to keep in mind, because you really don't want to be losing money. When you're selling puts, so the short put, basically it's more of a moderate risk level. So if that stock price does fall significantly below the strike price, you can still face some pretty substantial losses. Luckily, though, it's not unlimited in that direction. Now, of course, covered call, and I think you guys all know what covered calls are. So this is basically selling a call option against a stock that you already own. So it does reduce risk quite a bit compared to something called a naked call. And you'll notice we don't have naked call ETFs out there. So a naked call is basically you're selling a call option without owning the underlying asset. So this strategy does tend to be incredibly risky, as there's no limit to how much the seller may need to pay if the stock price surges. So I would recommend not doing any kind of naked investing like that. That actually sounds much naughtier than it really should be, for sure. Holy banana bread. All right. Oh, where is my guys? I just lost. There we go. Oh, there it is. There it is. I was like, I lost my chat window. For a moment. All right, now it's back. Okay. Because I keep on checking to see if you guys got questions along the way. Some common strategies, of course, when it comes to options, covered calls, and we've kind of beat them to death, but they're a great way to generate income. They're, of course, best use with covered calls is when you expect the stock price to remain stable or increase slightly. So that's kind of that thing. So with covered call ETFs, you'll notice that they tend to really love weak bull markets, flat markets. So basically, yeah, and also a weak bear market, not too bad as well. But they tend to like things to be a little bit. They don't want the extremes. That's kind of that big thing. All right. Now, one of the nice things about, of course, covered calls, they're making a lot of money because they're collecting all those premiums. And as you can see, that's why they don't want really volatile markets, is they don't want to be hitting strike prices. They basically want those options to expire and be worthless to the buyer so that they can keep the premium and they keep their stock, and then they just rinse and repeat and do it again. But of course, when it does come to risk, if of course that stock rises once again above that strike price, yep, they may very well have to pay it out. And that, as I mentioned before, that does limit the upside potential of that ETF. So not the best thing. Another option that you have out there is something called a protective put. So what this is you're you're buying a put option to protect against losses on a stock that you own. So this kind of acts as an insurance policy against falling stock prices. So the put gains in value if the stock falls, offsetting some of your losses. So it's almost like trying to stay even. Like if you think the market's going to be bad, you put in your protective put, and your goal is just not lose money overall. Like obviously one's losing money and the put is gaining money. So you're kind of playing it that way. And of course, the risk with that is that the cost is limited to the premium paid, but it does provide some valuable downside protection. So, and this is kind of more of an advanced option strategy. So if you guys are new to options, you're probably not going to be doing protective puts. You're probably going to start with the basics, the very, very basics. Oh boy. Oh, there we go. That's so good. There is another strategy called a straddle. So what a straddle is, in this case here, you're buying both a call and a put option with the same strike price and expiration date. So this here can actually be profitable if the stock moves significantly in either direction, making it useful in very high volatility environments. Usually you have a high premium cost due to purchasing two options, but gains are possible regardless of the direction of the movement on that. Now, and this one's kind of neat. In addition to, of course, the straddle, we have another option strategy called the strangle. So strangle is kind of like the straddle, but the call and put have different strike prices, typically out of the money. This is profitable with a large price movement, but generally cheaper than a straddle. The premium is lower than a straddle as well, and the strategy can still benefit from significant price movement in either direction. So it's kind of like you're really playing some of that math. Now there's also something called an iron condor. So this is selling an out-of-the-money call and put while buying further out-of-the-money options to limit potential losses. It can work well in low volatility markets while the price remains sort of range-bound. But basically the profit's limited to your premiums in this case here. And yeah, it's still kind of fun. All right, now the last little thing I wanted to mention on them is you probably have heard about the good old short squeeze. So basically, and those of you who are following the whole Wall Street bets thing, that was all because of a short squeeze. So basically, a short squeeze occurs when a stock's price rises pretty darn fast, forcing traders who had bet against the stock, so the short sellers, to buy back their positions to cut losses further, which of course further drives up the price, because that's what happens. You drive that price up, you're basically plowing through strike prices, and these guys are like, uh-oh, we have to now buy the stock because they basically have borrowed that stock because, you know, they don't own any of it, so they're buying it to give it back. Yeah, it's not great. Well, it's not that they don't. See, basically what they've done is they've borrowed the stock from one party. They have then put the short on that stock. All of a sudden, the strike prices are hit because the price is going up, and those stocks that they initially had are gone. So that's where they're left with no stocks. So then they have to buy them back, and of course at the new price, which is nice and high, which creates that whole, it sort of perpetuates the whole upward pump when this happens. So it can be very interesting to watch, and as Wall Street bets have demonstrated, you can make some money on it, but highly, highly dangerous. When you have a short squeeze going on like that, you almost need to get in right at the beginning if you want to make any money on it, because usually by the time you've already heard it, like, you know, people are talking about it on the internet or on the news, you're at that point where if you get in on it, you're probably going to basically be financing some of the people who are taking money at that point. So you want to be really, really careful with stuff like that. Yeah, so basically, as you know, as I sort of mentioned before, this does occur when there's a large number of call options. And that was the whole thing with Wall Street bets, because they were like, let's show institutional investors that retail is not to be underestimated, and that's why they all went in crazy on whether it be GameStop or what was it, Bed Bath and Beyond. I think they did it, and they also did it on some weed stocks and BlackBerry, all of that fun stuff. But holy banana bread, what can I say? It definitely gets to be pretty interesting when you are looking at options altogether. I do not currently have an options account set up, so that's one of the reasons that I haven't. I can't just sort of pull one up and sort of say, okay, well, let's look at how we set this up in Wealthsimple. But I looked a little bit at it, and I was just like, okay. It doesn't look too hard, but I do want to get in there and do a few, even if it's just enough so that I can do a walkthrough on it, because I think options can be overly complicated if you let them. But like I said, for me, the big stumbling price, I think for a lot of people, especially new investors, is having to buy that 100 shares. Because you're buying 100 shares, that adds up. Like, take something like, take something that's, we'll look at NVIDIA. If you wanted to do options on NVIDIA, that's a lot of money. That's 100 times, and they're what, almost $150. So, that's that's like, what is that, 11,500? Hopefully my math is right on that. So you need to have some significant money to do it. So a lot of times what new investors do is they get in on them penny stocks. And that's not the best route to go, because with the extra volatility I find in penny stocks, I will say this: if you are going to do options on penny stocks, I would try to go with shorter options. I wouldn't go into anything long, because there's just too much. There's too much that can cause that price to either to plummet or to rise. Very easy to hit some strike prices. So I would be a little bit careful with them. Ideally, I think if you're going to be doing options, you probably want to stick to stocks that are at least $5, at least. And I know sometimes your budget is kind of where that all comes in. But yeah, those are options. Oh my God. Oh, my chat wasn't advancing. I just realized there's a whole bunch of stuff here. Holy banana bread. All right. Let's see here. Paul says, I totally forgot. Leaps are talked about with the MicroStrategy people. Let's see here. With options, your each contract of 100 shares are stuck until it strikes or expires. So yes, if you are this option seller, there's nothing you can do until it expires. Even if the buyer decides not to exercise it, it's not going, they're not going to, they really won't announce it until that option expires. So if you took out let's say you took out an option for a quarter, for 3 months, that's tied up for 3 months. Now, the only difference is if the buyer does exercise the option early, they can do that. If they do that, well, in that case if you're the seller, you've just lost those shares, and it's done. It's done. It's just done. You'll have to sort of lick your wounds. At least you got the premium, which is not too bad. What is Delta? Delta, that's actually it's a measurement. So it measures the option's sensitivity to price changes in the underlying asset. So it's like beta in that way. So a delta of 0.5 would indicate that the option will change in value by basically 50 cents for every $1 change in the stock. So it's just a measurement. It's a measurement. Now the big measurements with options are delta, theta, and vega. So, and gamma as well. All of the Greek ones. Let's see, theta. It measures time decay, or how much value the option loses as it approaches the expiration date. Because options will lose value faster as they get closer to that date. Oh my god, this is somehow making me think of black holes, and I know why, but I'll leave that there. Vega. Vega basically measures an option's sensitivity to changes in volatility. So higher volatility increases an option's premium, of course. And that makes sense, because if there's a higher volatility, there's a higher chance it could hit that strike price. So you're going to be able to get a bigger premium for that. And gamma, it measures the rate of change of delta as the underlying price changes. Basically, it indicates how stable an options delta is. So, yeah, those are stats that you could certainly look at and play with. I wouldn't get too bogged down in them as you're sort of getting yourself used to. Let me see. Oh, you're no longer sharing. Oh, yeah, no, I came back to full screen. I did come back to full screen. I came back to full screen. Yeah, no, I came back to full screen because, but yeah, I haven't actually written anything else on the board since then. Did I? Oh, maybe. God, need calculus math now. Yeah. Let's see here. Let's go back here. All right. Now we'll go back here to the board again. All right. Yeah, we got everything here, all this fun stuff. I did show you guys this part here, I'm pretty sure that you guys did see this, right? Hopefully I didn't explain this whole part while you couldn't see it. This was the example with BTCY. But it goes to show, this is kind of one of those things where, you lose value with options. But now here's the thing, like if you're an option investor and you're writing good options, yeah, you can definitely make some money. But here's the other thing too. I mean, if you don't want to do options yourself, there's nothing wrong with just, choosing your ETFs, your covered call ETFs. Let them do all of that hard work. Let them worry about gamma and theta and vega, because you don't have to. You really don't have to. Paul says HODL sounds safer. It is. But I mean, here's the thing, though. I mean, options can be fun, and if you're really skilled at it, and you've got really good, and your fundamental analysis is like spot on, you can make money in options. But always remember, no matter how good you are with options, if you're if that black swan decides to pay you a visit, it really doesn't matter. It could drive the price to your strike price, and you can just be out. It's as simple as that. It's gonna happen. Every option, kind of like the whole thing with investing, is you want to make more successful trades than losing trades. Same idea with options. You just want to have more contracts where your guess is right, and whoever, because you got to realize, people who are buying these, they're not, they're for the most part, they're seasoned investors, right? They're not spring chickens, so they're buying, meaning that they definitely believe, and they can probably make an argument for why they think the price is going to go in the other direction. So it's almost like a game, right? It's like who's got this market figured out better. Now, mind you, there are also people out there who buy options who just don't know what they're doing. Because you will, like right now, like anybody right now who's been, in the last couple of weeks, who's been buying, who's been shorting Bitcoin, they're just losing money. I mean, it's like, if I was going to short Bitcoin, I would wait until I see some evidence that it's actually going to start going down. And for me right now, I can't see it going down before 100K. I'm kind of like, I'm on that 120K fence where I'm sitting. So, yeah, it's not too bad. It's not too bad. Let's see. Paul says, some of MicroStrategy YouTube people talk about a 793 day option at 750. Get paid premium now, and worst case, you get sold out at 750. Okay. Interesting. I mean, yeah, there's lots of strategies that you can probably come up with. Covered calls, they're doing it. They're doing well at it. They've got a nice system down with the way that they're running. And that's the whole thing. I think for most of us, getting into options, it's more or less get your feet wet. Try not to lose too much money. If anything, there's probably, and I don't know if there's actually any good Canadian options channels. It's too bad. There should be. There really should be. But it's just something to keep in mind. Something to keep in mind. All of that fun stuff. I gotta say. Yeah, and I was like, and one of the things that it was kind of funny when I put up the vote this week, I was just like, this is a really busy week. Let's, and they're like, and then it's like the first response is options. I'm like, I don't want to do options. But that's fine. I don't mind. Yeah, Paul, when Bitcoin goes up fast, people always say the shorters are getting wrecked. Oh, they are, absolutely. Because you got to look at it. You're hitting strike prices, and all of a sudden these people who are shorters are being forced. Basically, because what's happening is they've set it up in that. Here, let's go back here. All right, so somebody who's shorting Bitcoin. Let's just say, for example, right now Bitcoin is sitting at we're going to just say 80K. I'm just going to go with the K, right? So if somebody is trying to short, all right, so they're expecting Bitcoin to be going down. So that's kind of their whole idea of shorting it, right? So what they're going to say is, because they're expecting Bitcoin to go down, they're basically going to say that they will sell. Yeah, all right. So in their case they're going to sell their shares at a strike price. So if we're at 80K, let me see here. What they might do is they might set their strike price at, they're going to set it, of course, above it. Maybe they're setting it at like, maybe they're setting it at, actually, you know what? Let's just go to 88K. There we go. Whoa, we just changed that. They're going to set it pretty high. They'll basically say, okay, if it goes to 88K, we will sell it at, we'll sell it at 80K. Because that's where they're at right now. So they're saying that, but they're thinking that it's going down. They're thinking it's going down. So what they're hoping for, of course, is they're hoping that actually happens. But all of a sudden, Bitcoin goes flying up, and let's say it's up here at 95K all of a sudden really, really fast. Well, we've blown through their price, and they're now forced to sell. Basically in this case, they're forced to sell 100 Bitcoin. Now here's the thing with shorts on Bitcoin. I don't know if that 100 applies with crypto. We're just going to assume it does, because I haven't heard otherwise. But yeah, in this case here, they're going to have to sell 100 Bitcoin at 80K when it's worth 95K. So they're basically taking a 15K loss off of every Bitcoin. So 15K, well, if you were to multiply that by 100, you're looking at 1,500K. So that's basically $1.5 million. if they, if it's 100, I don't know. I know the 100 is for stocks because I'm coming from the stock side. But what I need to know is I don't know about Bitcoin. Let's find out. Let's find out. You know what? Let's find out. Why not? We got a computer here. All right. Okay. Bitcoin options. Minimum. Let's see what we get here. All right. The minimum tick is generally 5 points, equal to 25 per option. Okay, that's not what I'm asking for. Bitcoin options. Let's see. How much do I have to trade? Let's just see if this is going to give me. Okay, apparently with Bitcoin you're not limited to the 100. You're not limited to the 100. It looks to me like you can do well. This here is saying that that there's contracts with let's see, premiums over $10. You'll need more than $1. The cheapest contracts have. Yeah, so it looks like Bitcoin is, and that makes sense because Bitcoin being as expensive as it is. Good, that's good. But if you did actually do a contract on 100 Bitcoin, oh boy, this kind of just, I think this is maybe definitely really driving it home in this case. So, yeah, with Bitcoin, you're probably not going to be doing 100. But anyway, we just pulled that 100 in anyway. Testing you on options. Uh-oh. Do I have a written test? Do I have a written test? Is it multiple choice? I love multiple choice. It's actually interesting. A slight tangent. One of my English teachers back in high school, he was talking about how, most multiple choice, the way they're written, you can, just without knowing anything about the subject, just by knowing about English, you can go in and you can usually figure out, narrow it down to 2. So, and he was talking about how some people have gone in using just English and they've been able to just pass some of some exams for subjects that they have had nothing to do with. So definitely kind of interesting. Oh boy. And my arm's a little, my arm is a little numb. I got my vaccinations today for the winter, so it's like, I remember the good old days when you just went in and got 1 shot. Now it's 2. Hopefully we don't have another pandemic and then we end up with 3. But yeah, good old 2. But yeah, just so, yeah, it'd be interesting to look at the Bitcoin a bit more. I would love, just because I think it's ripe. I think it's ripe for making some money. Now, we did not talk at all about leverage. You can add leverage. Let's see here, ERAGE. Basically, all leverage is it's basically a loan. So your broker is loaning you enough money so that you can buy more. So let's say, for example, you were going to buy 10 shares. You could use like 2x leverage on that. So you end up with 20 shares. But the bank, the broker has spotted you for those 10 shares. So after you've done your trade on this, normally you're not going to do this for straight up investing. You'll do this for, like, if you're day trading or doing some short swing trades. You'll then give them back their $10 plus we'll just go plus interest. So they have it broken down to what the interest would be for a day. So the object is, in this case here, that's not $10. Let's just say $10 a share. So we're just going to make it easy. So in this case, let's say, for example, you bought, let's say you went with, so you had 10 and you were going to do, actually, you know what? Let's do 100 because, this way here, options, and you're doing your banana co again. Let's say you set a strike price of, we're going to say 1050. We're going to say 1050 because you're you know, and let's say, for example, your premium is going to be, we'll go with, actually, you know what? Let's go with $30. So we're not getting the 50 because it's harder to hit this strike price because it's a farther distance. And we'll say that you did it for, we'll just say 1 month. All right, TH, there we go, 1 whole month. Woohoo! All right, so in this case here, if you got to your best case situation is, let's say at the end of a month, Banana Co. was sitting at $10 and we'll go with 40 cents. All right, so that is what actually happened. Now, you did get 100, but in this case here, let's just say you paid for 50. No, we'll stick with 100. I don't want to get too complicated. You paid for 100, and then the bank paid. You used leverage to get another. So effectively, this becomes 200 because you've got 2 rounds of 100. So it's 2 options of 100. Now, what's ended up happening here is each of those rounds, you've got a $30 premium. So you have picked up basically $60 there. So you have $60, and you get to keep that no matter what happens. Now, you basically, at this point, you went from $10.40 up to, from $10 up to $10.40. So you made 40 cents off of every share. So that there is another $800 right there. Okay, so this is what you're left with. So you're left with a total of $860. All right, at that point, and this is just profit. At that point, it's just pure profit. Now, you are going to have to pay back half of those shares to the bank, but that's fine. You know, that doesn't come out of this profit per se, because this here is the profit on the growth that you're keeping. That's all for you. The initial principal, you know, that extra $100 right here, that's going back to the bank. Plus, you're going to lose some interest. So, depending on what their rate is, maybe, let's just say, let's say it's 15%. Well, that there, of course, is annual. So, what you're actually going to pay is you're going to pay, if this was 1 month, basically, you're going to pay 1/12 of 15%. So in other words, you're not going to pay very much. Let's just say I'm picking a number. We're going to say $10. I think it's actually lower than that, but in this case here, all of a sudden your 860 is now an $850 of profit. And that's fantastic. That's absolutely fantastic. It's like, yes, look at this. You've got yourself, and that's from using leverage. However, if this went the wrong way, and let's say it went all the way up to 1060 on you. So it went up to 1060, you were forced to sell 200 shares. So in this case, fine, you keep your 100 shares, but you owe the bank 100 shares. So you owe the bank, and not, it's $100 at the $10. So you basically owe the bank $1,000. So you owe the bank $1,000. You owe them the same interest. So we calculated at $10. All right, so you now owe the bank the broker, $1,010. How much did you make? Well, you've got to keep your premium. That's $60. So in this case here, you have $60 that you got from the premium. So that means that you are in the hole $950. Thank you, leverage. Thank you, leverage. I love it. I love it. But that's how that all works. So if you ever get to the point you're thinking, I'm going to do leverage, you want to make sure that you're really, really confident on what you're about to use that on, because, you know, that's a lot of money. Whereas if you lost without leverage, So let's say you just did the 100. It went up to 1060. So in that case there, you have the 100. So you still, you had to sell those shares. So they're gone. They're gone. Okay, so you're going to have to replace them. All right, so technically they're gone, but you did receive, they got to buy them at, let's see, what was their strike price at 1050? They bought them at 1050. So, 1050, so times 100, $1,050. So they give you that $1,050. This time you only had 100 shares, so you're only going to get $30 here on this one. So this here gives you, let's see. So you have $1,080. However, you have lost 100 shares. So that 100 shares, is now worth 1060. So you have to buy them back, and that's going to cost you 1,060. So look at this. Look at this, guys. Watch. You actually made 20 bucks. Even though you got liquidated, you still made $20. And these are the kind of smart trades that covered calls do, because they want to minimize that. But as you'll notice in this one case, you still made money. So you lost without leverage, you made $20. You lost with leverage, you lost $950. So it's one of those things just to keep in mind. It's it is all about math, of course, but you just got to be kind of careful. You got to be careful. All right, Paul says leverage credit card balance, transfer 0% for 12 months with a 3% fee. Oh, wow. Yeah, that would be interesting. No, I have to say I'm very, very careful when it comes to leverage. I personally don't want to use it. Like I'm okay with options. I mean, I'll probably do, I will do some options, at least for the very, being able to make a video on it. But the only way I'll use leverage, honestly, is I'll probably do it through, like when I do it through the ETF, at least I have a little bit of control. I can still lose my shirt. Like, when I'm using something like, well, here, let me show you. All right, we'll go to HOD. All right, so this here is the beta for oil. And we'll just go to the last year. So as you can see, this is when oil was doing well. If you were holding this, it was up around $10. It went all the way down to about 6. So you would have lost $4 a share. Then oil, all of a sudden oil falls, oil goes up, oil falls. So when you look at something like this, and let's even go further out, let's go with 3 years. No, that's even worse. Look at this. At one point, $42. That was back when oil was up above $100 a barrel. And we've never gotten back there. But for me, this to me is, and let's just go to the 1 month, it's a very situational thing. So if I'm in a situation where everything is peaceful and oil is oversaturated and oil is just falling off a cliff, that's probably here. So that's not a bad thing. But as soon as I hear of even a hint of tension in the Middle East, I would want to be getting out. So this to me is the type of ETF that, honestly, I would not trade it for more than a day. It's like if we're having a day and I know oil is just going to be falling all day, yeah, that's not a bad ride. But here's the problem. Once that market is closed, I have no control if all of a sudden Israel and Iran decide to rattle some sabers again. I got no control over that. I can't even minimize the damage. So I won't hold this overnight. I'll play it if I see that it's very clear that oil is going to be having a very bad day. Sure. Yeah, drill, baby, drill. That could drive oil down, and that might make this a bit of a play. But it is, as I said, it is an inverse ETF. They use a certain amount of leverage on here too. I think it's 2x. You want to be just careful, and if you're not, if you're even the remote bit nervous about using something like this, and don't have a clear game plan, don't touch it. Don't even touch it. Just leave it be. Because I'll tell you, this won't be fun. This won't be fun at all. So what can I say? All right. Well, that's all my material. If you guys got some questions, questions. It doesn't have to be about options. Questions about anything. Throw them at me. Let's go over here to the Discord. Oh, I thought I heard a noise. But it wasn't. All right. Tomorrow's video. You guys can already see it, I think, today. That's the Fairfax Financial. Definitely check that out. I will admit, I know they've come up in my lists, a couple of times, but when I was really looking at at them during this deep dive, I was like really surprised. I was just like, holy banana breads. That's absolutely crazy. But yeah. All right. Paul is asking. All right, let's just see here. How do the 2x ETFs work that say they reset? I'd have to actually look into that. I don't know. I know normal 2x leveraged ETFs. Normally what they will do is they will, so let's say, for example, if you're investing $100 into it, they would then, you basically end up equivalent to having $200 worth of that share. So whatever funds that they have in, they basically borrow that same amount. Well, not necessarily. In this case, necessarily, because it's a 2x. They will borrow that same amount. But now you will have some ETFs that will say, okay, well, we do leverage on 50%. So sometimes you'll get that as well. But he's that's, to me, that's just kind of an interesting thing. With resetting it every day, the only thing I can think of is that maybe it might be a situation where they settle up with their creditor every day or something. I'm not sure. I would have to actually, I've never seen that used in terms. So definitely interesting. Yeah, I always wondered about daily 2x and 3x. It's basically, they are risky. Just, I think the big thing from our perspective to be aware of with those is that, it's going to go up twice as fast or 3 times as fast, but it's also going to fall the same speed. So you gotta be a little bit concerned about that when you're looking at some of these ones. Like you can get. There's actually, I think Jim Cramer has an inverse ETF. Basically, they short everything he recommends, and I believe I don't know if it's a 2x or not, but I know it's just an inverse one. Let's see. Is there a live tomorrow? Yes, there is a live tomorrow. Paul says, watch it. They call the founder the Canadian Warren Buffett. Yeah, exactly. Let's see. MSTU, excuse me, is 2x in both directions. Yeah, most cases, I mean, any kind of inverse is going to be in both directions. It's just, you're just not going to, that's why I never keep them in my portfolio. So if I have a 2x, I am going to, because a lot of times, depending on the 2x, right? But a lot of times, especially if it's any kind of commodity or Bitcoin or anything related that way, I'm definitely not comfortable holding my money in it overnight when anything under the moon can happen. So, I just personally, I'm not going to do it. But I will use them situationally. For sure, no doubt about it. Let's see. Is it worth it to do covered calls on your own time, lack of volume, commissions, or just buy an ETF that does it for you? For example, a covered calls banks ETF versus buying TD or CM? That's a really good question. One of the reasons that's a good question is that there's kind of two things there. First of all, covered calls, doing it on your own, it's a lot of work. You need to do a lot of that due diligence from charting out what you think things are going to do. Whereas with an ETF, yeah, you're paying a small management fee, but they're doing it for you. They've got a team that's doing it, and they have contingencies in place for when things, basically when things go wrong. So they have, they hedge their own bets. So that tends to be a good thing with a lot of the ETF. So covered calls yourself versus covered call ETF. I think the covered call ETF for most people probably makes better sense. Now, a covered call ETF versus the actual asset. That's always kind of thing. And I know you kind of were talking about doing your own covered calls on like TD or what's that, CIBC. It's actually very interesting. I did a video a while back where I compared, I think it was Tesla. I compared Tesla to two of the different, to a covered call version of Tesla and a synthetic covered call version of Tesla. And the total return wise, Tesla won. And they don't even have dividends, which was kind of funny. But mind you, that happened to be at that time. Now that we're in a stronger bull market, maybe that'll be different. I'd have to run those data again. But a lot of times you will get, like I think right now, Tesla will definitely win in this time and age. I mean, Tesla has been flying up since the election. So definitely something to keep in mind. All right. Paul is talking more about MTSU. Let's actually bring them up. There we go. Oh, of course I don't have them. Oh yeah. Don't have it yet. I guess I won't be bringing them up, but let's see. And JJ saying doing your own calls is only worth it for highly volatile stocks. Bank stocks like TD and CIBC have pretty low implied volatility, so premiums are super low. Yeah, and that's what it does boil down to. Like, you may think, oh, I know exactly what this stock is going to do, but if a stock is that predictable, chances are you're not going to get really high premiums for it. So that makes it where, it narrows the room you have to play. So yeah, it can be a troublesome issue for sure. All right. Let's see. Paul says, my experience with MSTU 2X daily reset ETF sold 50 MSTR to buy 100 MSTU at the day's peak. Then it went down. The next day sold MSTU to buy back MSTR. So in the end, I only got 48.5 shares back of MSTR. So there you go. So you basically lost 1.5 shares in that whole process. So, it's kind of this funny thing. Like, you right now, like when you're looking at everything from MicroStrategy to Bitcoin and some of, I'll even throw Tesla in there, some of these severe pumps that we're seeing in these assets, sometimes it's fun to try to juggle things to try to maximize your profit. But in many senses, you can almost just sit still and just soak it up because it's going to happen. The big thing, though, and this is the big thing, like I know Paul's doing really well. You want to have an exit strategy because you don't want to get to a situation like, let's say, for example, Bitcoin goes up to 120 where I'm expecting it to go. You don't want to get to a point where you get up to 120, you're sitting there, you're loving all this money you got, and then you get caught off guard as all of a sudden it falls into the next crypto winter. You can watch that 120 maybe even fall all the way down to 60. So, your entire portfolio could get cut in half. Now, if that does happen to you and you get caught that way, biggest word of advice, don't sell your Bitcoin because, it will come back. Now, the problem is, though, if it's in an ETF, every other ETF fine, but if it's in the purpose high yield ETF, so the one with the dividends, you're not going to get back. You're going to lose, you will lose some of your money. There's no way around it because you will not get back up. All right, but let me come back here for a moment. All right, yes, I'm fine. Let's see, why am I on Tesla? I don't know. We're going to go to Bitcoin. No, I don't want to verify personal information on the middle of a live stream. Oh my God. It's funny. This thing has made me verify my personal information like quite literally. There we go. Quite literally 5 or 6 times today. All right, let's get down here to Bitcoin, and I'm gonna come here to. Let's go to. I'm gonna go to the 1 week. All right, here we go. 1 week. Good boy. All right, because this is what I want to show you guys. I want to come back here. Bum, ba-dum, bum, bum. All right, a lot of flat weeks there. Oh, I think I overshot what I was looking for. I'm actually looking for. All right, here we go. 21. All right, let's pull this all up here. All right, this is what I'm looking for right here. So, in 2021, we had this big peak. We got up to like 64,000. We had a correction immediately after it, and so we came all the way back down. Then we came back up and we did a double peak. So this time we got up to like 69,000. Fantastic. But look at it this way. If you had bought, let's say you bought on the way up here at 69,000, almost 70,000, it fell all the way down here. Like it actually made it down. It sort of peaked. It sort of wicked down to 15,000, but around 20,000, 17 to 20,000 is pretty much where it went down to. So if you think about it, that's a lot of money. If you bought your Bitcoin up here and you sold it down here, oh boy. Well, number one, that's a big loss. Number two, look at what patience would have done. Bang, 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 retrace, and then exploded. It's actually interesting. I'll show you guys something here. All right. Oh, I didn't want array. Did I do array? I did array. Sorry, I just want a trend line. Here we go. All right. All right, give me a second trend line. All right, so actually really interesting is that Bitcoin was in this channel, which comes like this. This is kind of like a flag. So what generally happens is when you have a flag like this, and this is on a longer term chart. All right. You can look here at the length of the flag, and that's typically where we can expect that breakout. Now, mind you, I have to straighten this out here. So yeah, and that breakout from this pattern, as you'll notice, is up around 117. So I was talking about 120. So we're in that area. So that'll be interesting to see if we get there. But that's kind of that big pattern that they were in, breaking out of that channel, that sort of flag, that whole pendant thing, or flag, whatever you want to call it. It's kind of an interesting thing. That's kind of where we are with Bitcoin at the moment. So definitely interesting. Let's see here. Let's see. Tesla going down all day today. Yeah, so an inverse Tesla may have been a good buy today for sure. Let's see. With yesterday down 5.6% and today flat from November 4th, still up 45%. Yeah, that's not too shabby. I guess things happen fast sometimes. Time in market, not timing the market. Do you have a TradingView subscription? Yes, I do. Playing BTC is too boring. I've been playing and holding MSTY and CONY. And man, they've done well so far, taking some profits off the table. Yes, so this here, MSTY is a micro strategy. I believe those are the Yield Max versions, and Coney is for Coinbase. So now those are synthetic covered calls, so they're kind of interesting as well. They're like writing covered. They're basically a form of naked covered calls. If you guys are naked calls, as we were mentioning. And let's see. Paul says also play pair trade MicroStrategy Tesla when that equals more than one by a bit sell some MicroStrategy to get more shares of Tesla, and in reverse, not the whole bag, just part. Okay, yeah, I mean it's fair enough. I mean, you just want to basically want to make sure you're doing your due diligence, make sure you get everything going the right way for you when you're doing this. So yeah, it's not shabby. It's not too shabby at all. And Paul, I've seen what Paul's doing. And he's got some success. He's got some success going on in his portfolio. So I have no complaints. Oh, coffee is so good. But of course, because I'm having coffee this late at night means I have to stay up for an extra half hour tonight. Just to give it a chance to get through my system. All that fun stuff. All right, guys. Well, this has been another one. And we've been here for what? More than an hour. Yeah. Oh, yeah. Look at that. About an hour and a half. So not too shabby. We're going to do this again next month in December. So come up with something special. Think of something fun. Yeah, I can't wait. I mean, December is going to be a crazy month on the channel. So, yeah. I figure January 1st I'll be rocking like a zombie. But it'll be worth it. It'll be so worth it. All right, guys. All right. Oh. We got a question. Just to keep me on the line, send me off on a coffee question. What's my favorite coffee? All right. I am weird. I'm going to put this out here. I am absolutely weird with coffee. I don't like instant coffee. Don't like instant coffee at all. Brewed. I don't like brewed coffee. I don't know why I said instant. What I'm drinking here, this is actually, it's Maxwell House Instant Original Roast. I love it. I'm just not a fan. Like, I'm not a fan of brewed coffee. Like, I can go into Tim Hortons and I can drink it, but I'd rather have my Maxwell House than that. Most of the stuff at home, like anytime I've gone to visit somebody and they're like, oh, would you like coffee? I'm like, oh yeah, sure, I'd love a coffee. Then they bring me a crude coffee and then I have to pretend that I'm still enjoying it as I'm not. Because, I don't want to win. There's nothing worse. It's kind of that whole thing. Where I come from, we have a saying, don't look a gift horse in the mouth. And that's pretty much what I sort of feel like when if I go over to somebody's house and they make me a coffee, and even if it's horrible, I'm going to pretend. Probably the best example of this is I'm not a big fan of tomatoes. Not a big fan. Like, I'm okay with a tomato on my burger. I'm okay with cherry tomatoes. But to me, a tomato sandwich would be a nightmare. I went to my aunt's once when I was a kid. And she was like, oh, would you like a sandwich? And I was like, oh, yeah, absolutely. Thank you. And she made me a tomato sandwich. Oh, my God. I had to pretend I liked it as I ate the whole thing because, being Nova Scotian, I had to be polite. Oh, boy. It was not fun. It was not fun at all. It was, it's probably, it was a nightmare. I'm probably going to have dreams about it tonight now that I've remembered it. But, yeah. So anyway, that's where your coffee question has got us, has taken us to. Let's see. Paul says JJ semi-retired by working part-time 12 to 20 hours a week, mostly 5 to 9, and Saturday 11:30 to 8. Nice. And JJ says, I prefer my matchas. Oh, you know what? I love matcha. It's actually funny. I used to work. I was a training manager for an internet company in Vancouver, and one day I was going downstairs with a couple of my trainers, and we went to, I think it was a Second Cup or something like that, and they had this thing up. They had a thing up for matcha. I was looking at it. I'm like, oh, what is that? And the person, the barista was like, oh, that's a really healthy drink. It's really good for you. I said, okay, well, let me have that. So she made it for me. I went down. I sat down. I took a drink of it. And so my trainers were looking at me, and they're like, well, what do you think? I'm like, it tastes like lawn clippings. They were like, oh. And so I drank it. I was like, okay. I said, now I know what it tastes like to drink my lawn. Next day I came down, and I was like, I kind of want another one. And I got addicted. I pretty much got addicted almost every day when I came down to the coffee shop. It was a matcha over and over again. So the taste grew on me really fast. So yeah, I do like matcha. And I have, there's a few things I like. Like another thing that I used to get a lot of in Vancouver that I almost never see that much out this way is wasabi. I actually am kind of a fan of wasabi. I had this contest. I was at a restaurant in Vancouver, and this guy I worked with, I picked up this big chunk of wasabi. Like quite literally, it was as big as a golf ball almost. Not quite, but it was pretty. It was closer to the size of a golf ball than a marble. I picked it up, and he was like, if you eat that whole thing right now, I'll pay for your meal. I was like, oh, okay. So I was smart. I put it on my spoon, and I brought it to my mouth. And what I did is I'm like, okay, let's science this thing. The issue is with all of that wasabi hitting my tongue. So instead of that, I threw it back. Pretty much I threw it back till I could just swallow it. And I did. And I was able to do the whole thing without them realizing what I had done. I made no face, not even a face. And he was just like, he was flabbergasted. He was like, well, I don't know what's going on. I was like, well, I said, I know what's going on. You're paying for my meal. And then he was like, oh, well, he says, yeah. He says, well, it wasn't that hard what you did. And so he picked up his same size ball of wasabi, and he tried it, but he didn't do the trick. And so I got my free meal, and I got to watch him suffer so badly. I kind of felt bad, but at the same time, I'm like, it's, what can I say? So anyway, wasabi, another one of those things that I do like, that I like. Yeah, exactly. JJ says, we got to go to all you can get sushi together sometime. I'm a big fan of wasabi and pink ginger. Oh, nice. Yeah. I know I love sushi. I love sushi. Actually, probably, how everybody has their own nationality that they really, really love. I would have to say, I really love Japanese food. And some of it I can't pronounce it, couldn't even tell you what I'm eating, but I've always liked it. There used to be a Japanese restaurant not that far from me, and I used to eat there quite a bit because still love it for sure. All right, everybody. Now it's 8:30. I gotta wrap it up. But this has been fantastic. We'll be back here in December. We're always looking for things that we can do. And I'm always looking for more ideas from you guys, from the channel members. Just other things I can do sort of enhance the channel membership. So always feel free to throw in the feedback. And also keep in mind, too, we have to think about the 5,000 subs. They're coming up pretty darn fast. So I imagine I'd be surprised if we don't hit it in December. So that might be just one other little event thing we have to throw in. So come up with some ideas. Let's figure out what we can do. I don't want to repeat anything. I don't want to repeat anything at all. But let's see. Do you like yakisoba and onoyiki? I don't know. I probably do, but I don't know. I've eaten a lot of Japanese food that I couldn't even tell you what it was. And And a lot of times, sometimes I could recognize what it is. Like I know, like I know that that's calamari or squid or you know. But sometimes I just don't know the name of the Japanese name of the dishes that I've had. But yeah, absolutely. I'm always game. I'm always game for sushi. I don't know if you can get good sushi on the side of the country. I know the West Coast. Oh boy, really good sushi for sure, for sure. So, all right. Well, first of all, I can't leave until we're big screen again. There we. Whoops, that's the wrong big screen. Let's go with. There we go. We'll go with this big screen. I have so many different screens. It's kind of funny. Oh, oh, I have one idea. JJ, why don't you, if you have that link I gave you before, why don't you grab it and drop into my thing, drop into the chat. I'll just bring you in for a second to see if I can hear you. I figure, why not? You're here, and that way there you can say goodnight as well to everybody else. All right, let's see here. No, but I'm just gonna. All right. All right. Just give me a second here. I'm pulling up the guest list. All right, here we go. All right, where is? Here we go. Right here, interview. All right, there we go. All right, I have turned the interview on. I'm going to drop into. And I'm going to drop into this place here where I can add somebody. So JJ should hopefully be here in a second. We'll bring him in and we'll see if I can hear him. That's going to be the big thing. All right. Of course, I've kind of put him on the spot. He's at home right now getting dressed really fast. He's like, gotta get some clothes on. All right. Oh, updating Chrome. Okay, no problem. I'll have a sip of coffee as Chrome updates. Always good. All right. Oh, yeah, this will be kind of cool. I know last time you guys could hear him, but I could not. I think it was trying to send him out through my microphone, and that just my microphone doesn't have speakers on it, so I think that's why it was. Oh, you're at the lab. Okay, all right, that's fine. It was more of a joke. Working late, not too shabby. Well, technically, I'm working late as well, so that's pretty cool. All right, and I am going to just double check to make sure it didn't turn things back so that it's trying to go through. No, it is set up to go through the Mac Studio. Perfect. All right. Well, we're just waiting on JJ to get his Chrome up to date. I may get to finish this coffee before JJ is finished. But it's worth it. It's worth it. I mean, any of you guys watching this at home, nothing important is going to happen after this point. So if you leave, I'm not going to feel like no, you left before the video was done. Yeah, no, I did have. Oh, by the way, I had a meeting today with Evolve. So they were basically just getting. It's more like the feelings. Like they haven't figured out yet what they want to do with the channel, but. All right, let's just see here. Guest is in the green room. All right, let's, okay, we got two. All right, add. All right, let's do that here. All right, here we go. All right, we're assigning you to guest one. Say something. Anything?
Oh, wait. Can you hear me?
I can hear you.
Okay, good.
There we go.
I mean, no one's in the stream now anyway, so it's like perfect timing. Because I noticed that there's a big zero button that's people watching. I don't know if that's a glitch or something or.
Oh no, it's because it's private. Because
Oh, okay,
in the
okay.
private streams like this, it will not show you how many people are
Oh,
actually
okay.
here. Like I bet you right now, Paul is probably here. Like Paul's always here. See,
Oh,
there
yeah,
we
I
are.
just saw him post a comment. That's hilarious.
Yeah, exactly. That's what it was. So it was kind of a weird situation. I don't know why, but it was trying to pump the sound out through my microphone, and
What? Okay, that's kind of
yeah,
weird.
yeah. So I don't know why, but it probably it probably did that when I updated to the newest iOS
Mm-hmm.
because I haven't had a guest on in a bit. So that's what I
Yeah,
think
you haven't.
happened.
I've been pushing for that, and I finally happened like after a month.
Yeah, and I got this mode, and let me show you the other mode.
Okay.
We also have this.
Yeah, Paul. I'm working late at the research lab, so that's why it looks like what it is. Doing some pipetting work right now. I don't know if you can actually see this, but yeah, it's my
Ah,
little desk there with
doing the
everything.
pipette.
Yep, benchtop work. So
Always
I
fun.
don't know, Candace, if you remember from your biology and chemistry days. Did you do any like dry lab, wet lab experience, or mostly just dry lab and courses?
Oh, I did a little bit of everything.
Okay, there you go. That's probably familiar
My
for you.
actually my second year was my most brutal year when it came to labs. I did 5 a week.
Whew, that's a
So,
lot.
yeah, and
Damn,
each lab was 2 to 3 hours. So, but
damn.
yeah,
Okay,
I'm trying to
that's
remember
a
what was I
lot.
taking. I was taking zoology. Uh, let's see, zoology, human physiology, inorganic chemistry, organic chemistry, and there was something else I was taking. Oh, what the heck was it? Oh, microbiology.
Okay,
So
very
yeah,
very cool.
yeah.
So
So I
I don't know
thought,
if because zoology is no longer offered anywhere. I think I know it's a pretty niche course, but everything else I do remember. Inorganic
mhm.
is so fun, but
Yeah.
it's
Well,
pretty
that
hard.
was the thing. Like I did zoology is technically a first year course, but I did botany first year because you could choose botany or zoology, and I just didn't have room for it first year. Because I mean, first year I did what did I do first year? I did botany, um, physics, calculus. Uh, I did it. Oh, what was it? I did some one type of chemistry. I can't remember what it was. Um, and English because I had to do 1 year of English as well. So my
What kind of
first
English?
year I was getting
Like
rid of the basically getting most of the requirements that I no longer would need anymore out of the way.
mm-hmm.
But then by second year, at that point, I decided to do a double major, only because the university said I couldn't do a triple major because I wanted to do physics as well.
You want to do a triple major? Dang.
Yeah, but they wouldn't let me.
You must
They're
have been a
like, you can do
smart.
a double major and then you can come back and do physics if you want. But
Did you end up doing physics, or was that
no,
the
no,
end of
I didn't.
physician Candace?
Yeah, no, I didn't do physics. But at the same time, I mean, I still know a lot about physics and astrophysics and yeah, it's just one of those things where I was just like, the problem is to do physics means I'd have to do a whole bunch more math. And after first year calculus, I was just like, oh, do I really want to go any deeper into that? But it was also, I think part of it too is every calculus professor at the university let their students bring in one formula sheet with them, except
Mm-hmm.
mine. Mine was the only professor who basically said, no, you have to memorize all the formulas.
Oh, that's rough.
I know. It was brutal. It was very brutal.
How
But
did you do?
what's that?
How did you do? How did you end up doing, if you remember?
I got about a 70, I think. Overall, that was one of my worst classes.
I mean, for the fact that you had to memorize all the formulas, I'd say you did pretty well.
Yeah, that was the whole thing, and it was just like, and he was also, it was I don't know, it's just a bad luck because he used to give an assignment every night that bare minimum it would take you an hour to an hour and a half to complete
Whew.
every single night.
Did you have time for other classes?
There was
Damn.
one night. There's one night I just couldn't. I just couldn't do it. I was just like, I can't do it tonight. So I went in. I went in the next day, and of course I
Uh-huh.
didn't hand it in because I didn't do it. And then the following day, when he was handing those back, I just walked up to him. I said, "Where's mine?" And he was like, "Oh." He was like, I must have lost it. What's your name? I gave him my name, and he wrote down a 10 out of 10. I'm like, great.
Okay.
I'll take it.
Okay.
But my biggest accomplishment, I think, in I had to write a term paper for physics and one of the what was it, human physiology. So I basically,
I hate theology.
yeah,
Yep.
I basically did a paper on basically electrical, sort of the electrical resistance within action potentials, and compared it to general, physics when it comes to electricity and electrical theory.
Hmm.
And by doing that, I was able to hand in the exact same paper to two classes. So
Very
anyway,
smart.
that was the thing. That was the thing. All right, here I'm just gonna quickly get through Paul here so that
Yeah, yeah, yeah. For
we
sure.
can close out here. But now you can now you're back. Now you're back. That's good. All right. You already got the lab thing. What was chemistry that was all math called? Um, I don't know if there was a chemistry that was all. I mean, there's a lot of math in chemistry, but not that much. Physics used a heck of a lot more math. Now, if you get into astrophysics, the math gets absolutely ludicrous. So just something to just something to put out there. Paul says I hated control theory and electrical engineering technology. Let's see. I love math and calculus, but don't ask me to do that now. What? But Paul, what if I need to know the area under the curve? Let's see. I had problems helping my daughter's math homework. Had to look everything up again on how to do it. Oh yeah, I can bet. Yeah, it's one of those things. Like, I'm like, there's a lot of math that I have probably forgotten that I'm like,
Same.
you know, like I don't think I like right now. I probably don't know how to use a matrix anymore. I think I covered that once, like in grade 12. So yeah, there's definitely a lot of math out there that I that I don't know anymore. But yeah, heck, I'm pretty good with financial math. But yeah, there's a part of me that's like, you should just go refresh your memory on calculus. Come on, you want to do a derivative or two, don't you?
Yeah, for
But
sure.
I'm just not there now.
Speaking of
Just like there's also part of me that says I want to do an oxidation reduction calculation. I'm like, no, no, I don't.
oh yeah, brings back the good old days.
Or it's time to go titrate something. Nope, no, it's not. Last thing I'll leave you guys on this funny little story. In organic chemistry, we always had to synthesize different compounds in our lab, and they always ended up being basically a baggie of white powder, and we had to take it home with us because we had to actually attach it to our lab reports. And that were there. I don't know if they were actually going to look at our powder or examine it, but they wanted a copy of the powder we created each time. And I was always like thinking, what if the police ever stop me for some reason and they find a baggie of white powder on me? How am I going to explain this? So I used to be very paranoid about that, but it never happened. It never happened. No, I've never ever got questioned about my baggie of white powder. Oh God, organic chemistry. So much memories. Um, Probably, actually, believe it or not, the best lab that I had was inorganic chemistry. He was a horrible teacher. He basically sat in class. He would sit there and just read word for word from the book for an hour each class. That's all he did. Nothing else. Just read from the book. But when you got into the lab, he was alive. He was actually very hands on, and he was the type, like, I know one time I get in there and I was just like, look, I said to him one night, I said, can I do next week's lab too, because I have a doctor's appointment. And he was like, sure, I'm going to be here for a while, go ahead. So he used to just be like, you could stay in the lab as late as you wanted to. And he was pretty cool with the lab. But anyway, all right. All right, everybody.
Last question.
Oh,
Since how did you get into options in the first place? What I'm curious about, and why don't you actually trade options yourself? Isn't that more? Can't you make more money than just trading regular Bitcoin?
um,
Since it's that
yeah,
much.
okay. Well, no, I mean, I think the thing is, I've been so wrapped up in stocks, and then probably because I went into YouTube and I got sort of all my time got sort of focused into that arena and the arena of what I'm doing on the channel. I think that kind of sort of eluded me away from stock options. It's just like, it's like I don't have the full time to dedicate to them, and that's a thing. But I'm now at that point where I'm thinking I definitely probably need to make a video on them. So now I'm getting
Yeah,
that
for sure.
justification. Um, could I make more money? I probably maybe. It's I don't want to
And
be.
people definitely will watch like if you do like live trades because in especially in American YouTubers, the ones who do option trading, they it's a very lucrative and like a
Yeah,
lot of people watch. And I've noticed that Canadians, like Canadian YouTubers, nobody really trades options. Like nobody does this stuff. So it's like
yeah.
it's a huge hole that needs to be that can be tapped into. So think
It
about it.
is. It is.
And it's
Um,
even why like I like I know the basics of options, but like I'm not sophisticated enough to do it. And plus, it's very time consuming. So like eventually, like I'm thinking about it. If I do decide to like work less and stuff, it's something to go into, and
yeah.
definitely will document that. But it's just like something not right now. It's just like too. It's way too. You have to do a lot of due diligence because yeah, like you said, like think about like stock movements or at least cap. If you do like naked options, oof, you will get burned so hard if you don't control it properly.
Yeah, yeah, no, absolutely. And that's the whole thing. Um, I think it just boils down to, like, even though I know there's a hole there, I also think right now I'm filling another hole. Like, I think I think basically the consistency that I'm bringing with this channel, I just don't see it anywhere else in the Canadian market. Like, I just don't see anybody who's being as consistent, who's pumping out the content, and who's making themselves as accessible as I try to make myself. So I think that's kind of filling a niche. I wish I would grow faster, but at the same time, it's like, you know what? The channel is steadily growing, so I can't complain. So that's always a good thing. Anyway, everybody. All right, this time we really do gotta go. Holy cow, it's almost 2 hours. These aren't supposed to go 2 hours. But
No, I think it's a nice
you're
change of
not
pace.
supposed to. But we will be back, of course, again tomorrow. We got a market close coming tomorrow. Oh, did you have a question?
Oh no! I was just like toots.
Oh, I saw your finger go up, like I got a question. All right, everyone. Until tomorrow, take care. We will see you again very, very soon. Bye, everybody.